Here comes some big dollar volatility with the Fed's preferred measurement of inflation this week. Guys, Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So the dollar is on an upward trajectory right now with the bulls back in control. If you look at my screen here, we've been rallying at 1, 2, 3 consecutive weeks. So some decent moves to the north for the greenback since managing to stage a rebound at this trend line technically, which has been in play since the commence of 2024. Remember, the upside trend here was really as markets started to adjust and pull back all their aggressive rate cut pricing, because they're really pricing in a number of rate cuts for 2024. And how many have we seen so far? None. And still, are there any on the cards? It's been pushed right back towards the end of this year. Now, the reason for this big upside momentum as well, picking up some pace, was because a couple of weeks ago, we had the FOMC rate decision and they were hawkish. They were bullish on the economic outlook. They were bullish on the labor market remaining tight, but they were not happy with where inflation's at and they want to see inflation coming down. So higher for longer. And if you look at the Fed's, this is the CME Fed Watch tool, okay? Looking at the latest probabilities of FOMC rate cuts and rate hikes to come. But obviously in this case, rate cuts. Now in September, you can see this is where all the volatility's at the moment. Just shy of 66% chance of them easing in September. So market's still looking for hope there, despite the Fed's dot plot indicating just one cut, only one cut as opposed to two this year. So right now the favor is in, or the momentum is with the dollar bulls. If you look here on the daily, okay, actually, let's drop down to the 4 hour. We had a nice little breakout of this flag after this period consolidation here within this sort of 105 to 105.50 area. Nice breakout momentum. And looking to, if you look on the higher time frame there on the daily, even more so on the weekly, you can see that next area of supply, that next target area for the dollar index, which is towards that mid 106 region there. Last here, obviously in April, where we sort of pulled back a little bit, and there in October 2023. Now, the big data for me does really come with the Fed's preferred measurement of inflation, the core PCE number, which is expected to cool. Okay, obviously we've seen the likes of CPIs and PPIs coming down. This is really in focus because this is how the Fed preferred to measure inflation, and it's expected to cool down to 0.1%. If that actually happens, you're going to see a little bit of a retreat for the dollar, obviously from being on this upward move. Obviously, look, if we just come out in line with expectations at 0.1, or more so, if we come out at 0.2% unchanged, right, the dollar index is going to push to the upside, and we're probably going to run in towards that 106.50 area and go and challenge this area of supply. So big day to keep an eye on. Ahead of that, obviously, still worth noting, pending home sales, unemployment claims, final GDP reading, and consumer confidence. All these are important because market's still trying to figure out if we're getting any cracks in the US economy, because it would push potentially the FOMC closer towards rate cuts, but really they are focused on inflation. On to JPY. Now, you'd notice there's a lot of yen volatility that continues in the markets right now. And the reason for that at the end of the day is, I continue to speak about this week after week, macros support yen weakness, because in Japan, rates are still low. Despite the fact they moved away from negative rates, rates are still low. So people are still in Japan borrowing money, right, where there's no interest having to be paid on that borrowed money, and then go and take it and investing in higher yielding economies such as the US, UK, Eurozone, Australia, Canada, New Zealand. You get the point, right? So we have outflows of yen weakness, and inflows strength into other major currencies. So that's why we continue to see that macro-based weakness for JPY until the Bank of Japan start raising interest rates, and we start narrowing that divergence, because there's a massive divergence with interest rates. Now, if you look here, we're going to focus this week on Tokyo Core CPI, all right, which is expected at 2%. The Bank of Japan really wants to see this number remain elevated in order for them to be acting, and raising rates, okay? So they really need to see inflation remaining above their target. They want it at 2%, but if not just a little bit above, just give them a bit of leeway, because when they start raising rates, naturally, when we're raising rates, remember, we could be cooling inflation down. Now, if you look at dollar yen, we're at very dangerous levels here, and I want to bring this on your high alert, high attention, that we're at intervention territory. We're intervened here previously, entering that 160 area. So keep an eye on that. And that's, look, at the end of the day, that's why we've continued to weaken with JPY, as I explained. But we are at levels where we could see intervention coming into play, right? Look at NZD yen, look at CAD yen, GJ, Euro yen. Obviously, the macros still support that yen weakness, but real caution as we head into intervention territory, guys. We're also going to be due plenty of volatility from the Canadian dollar. Now, as we know, the Bank of Canada were also one of the first major central banks to look at start cutting rates. You know, they cut previously by 25 basis points, and they have left the door open, of course, to more cuts, but it is very much dependent on where inflation goes. Remember, they need inflation to be coming down in order to be cutting, because they don't want to cut too prematurely, too fast, too quickly. Otherwise, inflation is going to creep back up again. Now, if you look here, we're going to be keeping an eye on the CPI figures due out on Tuesday, where inflation is expected to cool down, as you can see here, generally speaking, on a month-on-month basis, and a little bit on a year-on-year trimmed CPI expected to cool. So really, if these numbers come out lower, okay, lower than expected, you're going to see CAD weakness. Obviously, if they come out above and remain sticky, CAD's going to hold some ground versus its peers. Now, obviously, general forecast is for them to start cooling down, which could invite that CAD weakness. Now, interestingly for me, for dollar CAD, I've been watching this for a while, and on a monthly, we've remained in a very narrow range here. You know, we could even view this as a massive bullish pennant trying to escape this range. You know, the top part of the range is seen at 138 psychological, the downside seen at 132, so a 600 pip range there. And, you know, when you look left here, if we drop it down to the weekly, really bring it in perspective for you, if we're able to break down this heavy area of supply at 138, you can see we can really rock it up towards sort of 145, 146 territory. Look left. We've done it here in February 2016. We did it here in March, April 2020. And we've done it in the past as well before, as you can see here in 1997. So there's a lot of room and a lot of, you know, free reign for dollar CAD bulls to drive this to the upside, particularly if we see that divergence really expanding between FOMC holding rates and the Bank of Canada picking up pace with their rate cuts. More inflation data, this time for Australia. So we're going to have some Aussie dollar volatility now. As you may be aware, there's this growing divergence between the RBA and other major central banks. What is that? Well, basically, the RBA are talking about leaving the door open still to rate hikes. You know, and other major central banks are cutting rates and talking about rate cuts, but these guys are saying we could still hike rates, which is hawkish, which is bullish for the Australian dollar. And the reason for that is because Australia is still dealing with sticky inflation. Okay, inflation remains sticky. If you look here, CPI due out on Wednesday, expected to cool down to 3.5%. But when you look here, it's been sticky for April and the month of May. So they want to see that cooling. If this comes out lower, then expect Aussie dollar to really lose some ground versus its peers as we start to move away potentially from this hawkish RBA. But of course, if it remains elevated, even number at 3.5, 3.6, the Aussie dollar is going to strengthen. Now, if we look at AUD USD, this is one of the currencies that's holding up ground versus the dollar in comparison to its peers. You see the last couple of weeks we've remained in the green, and you could almost, obviously we're moving within a narrowing range. You know, ultimately we are trending to the downside, but the range is getting tighter and we are subject to a big breakout. But when you look on a daily, there is potential room. Obviously this could not play out, but there is room for this to play out should the RBA, that divergence occur. Inflation remains sticky in Australia, but then it cools down in the United States. This could end up playing out for that big bull flag, and we escape this range. We break the heavy supply at 6700, and this just rises to the upside. Or we could just continue to this respecting trend to the downside and obviously play out lower. But obviously, this is all very much dependent on this inflation data and, of course, you know, this divergence of what's going on between the central banks of the FOMC and the RBA. So plenty of volatility up for this trading week, guys. I hope you have an amazing and a blessed one. I look forward to seeing you on the next video.